And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday. It is also the last full week before Christmas. So a couple of housekeeping announcements. First of all, if you haven't done your shopping yet, time to go. Go get it done. Second thing is that this is our last week of shows here on our live shows for the Real Investment Show. After this week, we'll be off until January the 3rd. But, as is always the case, Brent has organized plenty of material for you over the holidays, but it will be on our podcast. So if you go to our YouTube channel, we won't be here for the next week or so, but on our podcast where we stream all of our podcasts, which is Apple iTunes, Spotify, SoundCloud, all of your favorites, Libsyn, all of those are out there. We will have best of shows going all the way through the end of the year, give you stuff to listen to if you just are so inclined. So we're not going to leave you empty-handed. We're going to make sure you have it. I'll still be producing articles over the holidays. I'll still have our weekly newsletter going out. So all that at the website, realinvestmentadvice.com. You'll have plenty of stuff to do over the holidays, but hopefully you'll be spending some time with family and not sleeping on the couch because you forgot to order your Christmas presents on time. Get that done. But there we go. Anyway, so that's our housekeeping for today. Did I miss anything, Brent? We're good? All good?
Good to go.
Good to go. Okay. See? There we go. All right, a couple of things. Microstrategy is going to join the NASDAQ 100, which I think is funny because the last time that we saw a stock kind of rocket off to the moon and then get thrown into the S&P 500, that was the actual peak of the stock. So hopefully it doesn't work out for the NASDAQ as it did with the S&P 500. Of course, super microcomputer crashed like 70% right after getting added to the S&P 500. We'll see what happens with MicroStrategy, but that announcement today that they'll get added to the NASDAQ 100. So that should give some volatility to the NASDAQ 100. So when we start to talk about the NASDAQ, we'll have some volatility to talk about. But speaking of that, Bitcoin did cross 100,000 this morning. So again, just, we're kind of watching Bitcoin do its thing at this moment. Again, lots of speculation about a new strategic Bitcoin reserve maybe kind of coming next year under the new administration. Some of the appointments for Donald Trump's appointments for his cabinet are Bitcoin friendly. So that's been certainly supporting the rise of Bitcoin here. After we broke out of this very long consolidation channel, Bitcoin has been kind of rising. Now, interestingly enough, we had triggered a sell signal on Bitcoin back on basically about the middle of November. And Bitcoin really kind of struggled within this consolidation channel. Finally broke out of that. We're about to trigger a buy signal on Bitcoin. So we could definitely see some higher prices on Bitcoin here just from a technical basis and momentum, year-end positioning, etc., into the end of the year. So we'll kind of see what happens here, but it kind of be worth paying attention to. Outside of that, not a lot of economic data this week. The big news this week, of course, is the Federal Reserve. They're going to cut rates on Wednesday. The real question, what's going to move markets this week more than anything else, is that rate cut, but really the outlook. Because now with inflation kind of being sticky here at the moment, expectations are that maybe the Fed is just going to pause here. So they'll say something like, hey, we're going to cut rates and then we're going to go to a wait and see type mode as we head into 2025. Not really guaranteeing a lot of rate cuts next year. Right now, the expectation is the Fed will cut rates by another 3 times next year. So what they say and how they position this is going to be really important for the markets anyway, because the markets are really kind of hoping for lower rates, a reduction in monetary tightness to help propel markets next year. So we'll see what happens. But that meeting's on Wednesday, so that's going to be the big driver of stocks really this week. And then next week, we're going to get into basically the holidays, and we'll have the Santa Claus rally coming up after that as mutual funds start to do portfolio rebalancing. So, we did see a bit of volatility last week. We had talked about that, kind of getting set up for this year-end rally. We had mutual fund distributions going on. That's why markets kind of really struggled last week to a degree. We didn't have a big correction, but markets really kind of struggled to make ground last week. So again, as we start to kind of look forward to the end of the year, a little bit more volatility this week potentially. We're not quite through fully all those distributions and rebalancing just yet. So again, see a little bit more of that this week, potentially into the Fed meeting, typically on the 18th of the month, or the 18th trade day of the month, which is on Wednesday. We will, you kind of start to see that rally for the year end. So again, once we kind of get through this Fed meeting, markets may be a little bit antsy going into that meeting. So a little bit more volatility today, tomorrow, Wednesday morning. Get that Fed meeting announcement out of the way, and then markets can start to kind of rally into the end of the year for kind of that end of the year positioning, window dressing, etc. But that kind of brings us to what you need to know before the bell this morning. Let's do a quick run around markets here real quick, just talking about a few different things. When we talk about the S&P 500, again, as I said, last week, we're going to have that kind of volatility, and that's what happened. Markets really didn't go anywhere, lots of up and downs last week, but really didn't do a whole lot. We're on a short-term sell signal, so again, kind of expect a little bit more volatility over the next couple of days, get a rally coming out towards the end of the year. Oil prices continue to really struggle here kind of on a longer-term basis, but recently we've seen kind of an uptick in some of the inflation data, and that's a function of oil prices have been rallying here very slightly. We are on a buy signal right now, and oil prices overbought, so I wouldn't expect a big push here higher in oil prices. In fact, that trend remains lower for right now in oil prices. And again, this is going to be more of a function of what's happening economically as well. While economic data continues to kind of be stronger than expected on some fronts, and is definitely stronger than what's happening in the rest of the world, the economic growth rate is slowing, and we are starting to see slower rates of economic growth, and that's being reflected in oil prices. So again, as you kind of watch this here, we're getting these short-term bumps in oil prices. That's feeding into some of the short-term inflation data, but the longer-term trend right now in oil prices is lower. The question is going to be, if we take out these lows at $66 a barrel, that's where things are going to get a little bit dicey in terms of some of the economic data. So kind of watch that 66 level. Oil prices are overbought here, so if we start to see a pullback to 66, take that out. That's going to kind of be a wake-up call to start paying attention to some of the other economic data that's occurring within the markets. Gold prices, we talked about this previously. Gold had gotten very, very overbought on that rally. We've actually been working through a very nice correction here, holding important support levels really at this 100-day moving average. Gold prices have kind of been stuck at the moment, but again, as long as you kind of hold about that 2,600 level, 2,650 level, gold prices continue to be in a positive bullish trend. Now, if we start to take out 2,600, that's going to be a much more important kind of signal in terms of what's happening with that commodity. But oversold here on a couple of bases, but again, not dramatically so. So again, a lot more volatility, but we kind of can see this, this compression of price, and eventually gold will make a move in one direction or the other. So pay attention to that breakout whenever that occurs. So if we do get that breakout of this kind of compression, that'll really kind of tell you where the next directional move for gold is going to be. Lastly, talking about the dollar. Dollar continues just to be a rocket ship here as of late. That is just a function that out of all the countries in the world, whether it's Britain, the Eurozone, Japan, China, basically the U.S. only is the only growth engine in the world right now. We're the only country really growing economically, and that's dragging a lot of foreign inflows into U.S. equity assets. Right now, foreign holders of U.S. equities is at an all-time record. The last time we were near this level was back at the turn of the century in 1999-2000. So again, just a massive inflow of money into U.S. markets. That's being reflected by this drive higher in the dollar. Fears of de-dollarization have now completely vanished because the dollar is back to where it should be. So again, this is just kind of a look. Everything's fine in the overall markets. Not a whole lot to worry about here. Nothing really bearish to be concerned about. But there are some risks that are beginning to build up and worth paying attention to. But that's what you need to know before the bell this morning. When we come back, we'll get into a lot of other stuff we got to get into today. We've got a whole long list. Don't go away. We'll see you in just a minute.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So, let's see, what is today? Today is the 16th. So, yeah, about a month and a half ago, we were here on the show. And we talked about that with the election of President Trump, we would likely see a pickup in optimism in some of the indexes that were economically significant. One of those is the National Federation of Independent Business. And we talked about this index before. People don't really pay too much attention to it, but it has a very high relationship to kind of what goes on in overall markets, what happens in the economy. And it makes sense because small business owners make up about 50% of all the employment in the country. They're a very big component of economic activity. I know we all focus on, the companies like Apple and Google and those guys, but out of the 6 million businesses that actually operate, we have like 30 million businesses in the U.S. Most of those have no employees because they're for trust, they're for estate planning, whatever it is. But they're LLCs and C corps that are used for non-employment reasons. So out of all those businesses that we have, only about 6 to 7 million of them actually have any employees. Most of those only have 5 or fewer employees. When you start talking about the Apples and the Googles of the world, out of 6 million, that's like 10,000 companies. It's a very small percentage of companies. They do employ a lot of people, but in terms of the overall economy, they're a very small percentage. So, when you start thinking about economic activity and what goes on, you start talking about, your nail salons, your local restaurants, your, all these businesses that are around you that are not part of Apple, Google, et cetera, right? But they're a very important driver of the economy. And so let me show you this chart. This chart was the NFIB Confidence Index prior to the election, right? Now, what's notable is that if you look at the date range at the bottom, the last time that we had this huge spike was just post the election of Trump the first time around. And, coming out of the financial crisis, obviously had a very big sell-off. Then the economy was recovering. Trump gets elected. Boom, giant jump in optimism comes along with the Tax Cuts and Jobs Act that he passed. Of course, the tax cuts were good. And of course, we had the COVID crisis. And obviously that certainly impaired confidence when you shut down the economy, but it never recovered despite the economy recovering. This was the interesting thing. Despite the economy recovering due to stimulus and all that, after Trump left office and Biden took over, confidence never improved. It got worse. And this had a lot to do with regulatory oversight and overreach by the government, et cetera, just really suppress small business owners. Now, again, you have to take this with a little bit of understanding that this tends to lean towards the conservative side of the ledger, because if you're a small business owner, you tend to be more conservative in nature with your outlook because you're pro-tax cuts, you're pro-deregulation, you're pro the things that generally come from the conservative side of the ledger, much less so than the Democrat side of the ledger. So this tends to lean conservative. So not surprising that when Donald Trump got elected, that you had a big surge, and when President Biden took over, then you had this kind of suppression. But it was a very dismal kind of 4 years. And this chart right here ends at the election. It's okay, Brent. So a couple of other charts that went along with that, of course, is taking a look at small business sales. Now, what drives businesses? Businesses are driven by retail sales, right? The things they sell. Post 2020, right? Or actually, post 2016, Trump gets elected. Expectation for sales were pretty high. They were in expansion territory. Post-COVID, collapsed, and then got a brief bounce when we sent checks to households. Business owners are like, yeah, if they have money to spend, I'm very optimistic about that. But after that, it just continued to decline for the next 4 years, because even though products were being sold, the rate of sales, the actual sales, were always falling short of expectations. Business owners are generally optimistic because they're running a business. They have to be optimistic. Otherwise, they wouldn't be in business. But the actual sales, what was actually happening underneath the economy, despite the fact we're getting a lot of economic headlines that were great, right? What was actually happening on the ground was a little bit of a different story. And so there was this big gap that was going on between what kind of people saw on television and what was actually happening with retail sales. And those were pretty dismal. And then, of course, the one thing we talked about on the show at that point was that there was this big gap. There's a very big relationship, correlation between the annual rate of change in the NFIB Confidence Index and small cap stocks. And on November the 8th, this was just after the election, we said that we suspect that the next iteration of the NFIB report is going to show this massive jump in confidence to close this divergence that existed between small cap stocks and confidence. Now, we didn't know that at the time, right? But we just got last week, we got the latest version or the latest survey out from the NFIB. And not surprisingly, there was a massive jump. Now, this is the chart post the election. We went from 91.5 to 101.7. This is the biggest jump on record in a single month post the election. So again, not surprising. Business owners tend to lean conservative. So Donald Trump gets elected, tends to bode well for optimism. Why? Because now business owners are expecting what? More tax cuts, at least the extension of the Tax Cuts and Jobs Act. That's not going to go away next year like it was supposed to, or in 2026 like it was supposed to sunset. So that won't happen. So that's very positive for business owners. And more importantly, deregulation, all these type of things. Even tariffs are a benefit in theory to small businesses, because it will, if a product coming in from China is now more expensive, small business owners that provide a similar product here will have an advantage, or there will be an opportunity for small businesses to start selling a product that is now being tariffed somewhere else. So tariffs can actually work into the benefit, because consumers make choices based on prices that can give small businesses a bit of a lever. So again, all those things that Trump promises at this point as president, it certainly bodes well for small confidence. And this is why, if you take a look at their outlook for economic confidence, right? So you ask the small business owners, what's your outlook for the economy over the next 6 months? It just went through the roof. And is back at some of the highest levels we've seen really since Trump was last elected president. Now, here's the good news about this. Now, as I said, we're going to look at some indicators compared to real economic data. And the point of this is that if you take a look, and can you bring that chart back up for me real quick? If you take a look at this data, whenever there's a big spike in the economic data, the economy does tend to improve. So if you're worried about it, if your thesis has been a recession is coming right around the corner, this data tells you that is not going to be the case. Because when you have very high economic confidence, that tends to translate into stronger economic growth. And there's a couple of reasons for this. So what makes up GDP? Okay, Brent, thanks. So what makes up GDP? GDP, the calculation of GDP, it's about 70% personal consumption expenditures. And then we add into that business investment, CapEx spending, government spending, and then we net out exports and imports. That's the calculation for GDP. So 70% of it's the consumer. That's what you and I do, right? But CapEx is a very important part of this because, again, if businesses are optimistic about the economy, then they're going to start spending money. And when they're optimistic about the economy, we should expect to see an uptick in plans to do CapEx, which we're seeing. There was a very big jump in plans to do CapEx, which corresponds to the jump in economic outlook. And it makes sense, right? If I'm expecting stronger economic activity, then I'm expecting the consumer to do better. I'm going to have to start spending some money on building out property, plant, equipment, inventory, et cetera. That all feeds back into economic growth. So again, if your thesis is a recession, this data suggests that that's not going to happen next year. Now, it doesn't mean you can't still have a recession. You certainly can. But doesn't suggest it'll come next year. Now, and the reason is that increased capital expenditure plans tends to correlate with stronger rates of economic growth. And you just had this big jump in CapEx. You should expect to see a increase. Now, not a massive jump, right? But a sustainable increase or a sustainable rate of economic growth into next year. Because again, their activity is not inconsequential to the overall economy. Now, when we come back, we'll talk about how this feeds into employment, because again, a lot of concerns as well about the employment rate. There was a couple of videos out over the weekend talking about the, employment's going to crash next year. Well, the NFIB says that may not be the case, and I'll show you why. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Show your love this Christmas by giving a used gift to somebody you love.
Nothing says Merry Christmas like a 2005 big screen TV.
Merry Christmas to you too, you little freak. On a roll this morning. Anyway, I may be divorced by the time I get home. It's better than stimulus.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just talking a little bit about the latest NFIB report last week, and all these charts and graphs are in this past weekend's newsletter if you want to go look at them for yourself, do your own analysis. But so we're just talking about CapEx, and it's an important part. But in order for businesses to do capital expenditures, right, they need activity. And so if you take a look at the economic cycle, right, where does the economy, how do we get there? In order for the economy to grow, particularly in an economy that's 70% based on consumption, consumers have to produce something first. So they got to go to work, they got to get a paycheck, unless you send them a check in the mail, like we did in 2020. But normally, you have to go to work, get a paycheck, and then you can go buy stuff, right? You pay your bills, you buy food, groceries, all those type of things, and live your life. Well, as you go out and spend the money that you earned, that increases demand for businesses. In turn, they have to hire more employees. If they hire more employees, they have a demand for labor. Wages go up. Wages go up, you've got more money to spend. So you buy more stuff, which increases demand. That's the economic cycle. That's the virtuous economic cycle that we live in and the way our economy works. So if businesses are expecting a need to do CapEx, they should be expecting an increase in sales. Now, remember I showed you how dismal that those sales expectations were. Here's the latest updated chart on that. Big jump in expected sales over the next 3 months. This is going to start to, if they come to fruition, now this is all a caveat, by the way. This is just what history tells us. These things have to happen. Right? So these expectations need to be met. If all of a sudden, I'm expecting all these things, but the consumer doesn't show up, all this reverses. And it can reverse in a couple of months. So there's no guarantee, but historically, looking at this data, it does suggest that the activities that we've taken on by small business owners will certainly start to translate into other activity. And so if I'm expecting an increase in sales, then I go, okay, well, I'm expecting this increase in sales to come over the next 3 months, so I better go do some inventory building right now because I got to meet that demand. I don't want to be caught short. I better hire a couple of employees. And so expectations for increasing wages and increasing employment has had a big jump as well. So again, small business owners are pretty much very optimistic across the board right now post the election, and they're looking for much stronger economic activity next year. Now, importantly, the reason I'm telling you all this is because this feeds back into the economic story. So I was just having this debate with Michael Pinto on Friday, and he was kind of all over the board. But we're supposed to talk about he's talking about the markets are going to crash by 50%, investors are going to be wiped out, and there's so many problems with that narrative. But it all hinges on ultimately a event of some magnitude that causes a reversion in markets. Well, it would also cause a reversion in the economy. So you're talking about that recession issue coming up. The problem is right now is that there's nothing in the data that suggests a recession is around the corner. Economic growth is reasonably strong. Unemployment rates are still very low. Economy's doing just fine. The reason that inflation isn't plunging towards 1% is because the economy's doing fine right now. It's not booming, but it's not terrible. We're growing about 3%. Inflation's running about 3%. That's right where it should be. If small business owners are right, we're probably going to see 3% growth next year, which means that inflation could be sticky all year next year at around 3%. It's not going to accelerate and go to 7 because your economy is only growing at 3. But it could be sticky here for a while and just not go anywhere. Now, that doesn't mean, none of this means that we have excluded, right, the probability of a recession entirely. Things can happen. And again, small business owners are very optimistic, but they've been optimistic before. But economically, it takes time for any of this to occur. So again, we'll see what happens over the next, few quarters, but going into next year, the increase in optimism is likely going to at least sustain economic activity to a degree. People feel better about the outlook. If we take the outlook for, economic improvement on both consumer side as well as small businesses side, those are all improving. So if I feel better about the economy, I'm going to continue to spend because now I'm not worried about losing my job like I was before. And I'm not worried about my income, and I'm very optimistic on the stock market because, well, consumer data tells us that. So there's no reason for me not to continue to spend in the economy. Even if I'm going in debt to do it, there's no reason to stop doing it because I'm not worried about anything else going on. So that's going to sustain economic activity a little bit longer than a lot of people may suspect. Now again, eventually we have to deal with economic dynamics down the road, but all I'm trying to make the point to you is that these near-term indicators suggest that concerns about an immediate recession, the world's going to fall apart again. I just get sent all these videos from people like, well, this guy says, the world's about to come to a roaring stop because of whatever reason. The data doesn't support that. So as investors, we have to continue to manage what we have going on in the markets, and right now everything's fine. Now, coming next year, I don't expect another 30% return year. This was a very good year for stocks. Last year was a very, very good year for stocks. Can we do it? Can we have a three-peat? Right? Can we do another year of 20% plus return? Sure. If you go back in history and only look at positive years, right? The average return year since like 1945 is like 18%. If you only look at positive years. So, when you talk about an average return of 8% or 10%, whatever your number is, that's including the down years as well. But in up years, there's very rarely a year that does 8%. It's either, less than 8 or it's a lot more than 8. About 57% of the time, returns are greater than 10% a year. So could we have another year next year where the markets are up 10, 12, 15%? Absolutely. Take a look at Wall Street expectations right now. Those are all in the 8 to 14% range next year. If you get 8, that may be disappointing after a 30% return year, but it's still a positive year. So, everybody's positive about next year. The data is certainly supportive for next year. And again, if there's a cause for concern, or at least a cause to be paying attention next year, is the fact that everybody is optimistic. And generally, when all experts agree, something else tends to happen, as the old saying goes. So we'll see what happens next year. There's a lot of things that could occur. We don't know, what policies are going to get passed that may upset the apple cart. We'll see what happens. Deep government cuts and spending could certainly weigh on markets. So there's things that can happen. And so I'm certainly not suggesting that you go into next year, just being overly optimistic about everything. But right now, things are okay. Sentiment's optimistic. That tends to be supportive of economic activity. That continues to keep things kind of rolling for right now. So just keep that in mind. The one thing, though, to be paying attention to is that as a country, we export inflation to import deflation. That's how we keep prices down. That's so you can buy a TV at Walmart for $1,300 or whatever, depending on the size of the television. And it's not $10,000 because we manufacture it overseas and then we ship it in. The U.S. right now, if you take a look at, so this chart shows you real economic growth of the U.S., Japan, and the Eurozone. We are the only country out of all those. So the Eurozone makes up 19 countries, Japan, obviously, and the U.S. We're the only country that's growing right now. Historically, that gap is not sustainable. So either the rest of the world will start generating economic growth next year, or we're going to slow. The potential for economic slowing next year, now again, I'm not saying recession, right? But to go from 3% growth to, say, 1.5% growth next year, that's a more reasonable probability than the Eurozone all of a sudden getting this huge traction of economic growth. Maybe that's possible. Historically, that's not the case. China's doing everything they can right now with stimulus, and they can't really seem to be getting traction with that. And they've got other issues that are going on, so we'll see what this looks like. But when you take a look at the rest of the world, we're the only people that are growing. And that's why you're seeing this massive flood of money coming into the U.S. right now, to U.S. assets, the U.S. dollar, et cetera, because we're the only country showing economic growth. Where do you want your money? I want my money where it's growing. That's the U.S. So I certainly don't want you to think I'm being Pollyannish and saying, oh, everything's great next year. What I am saying is that because of this boost in confidence, the risk of recession has been largely mitigated for next year, just next year. I'm not saying anything about after that. But the thing to pay attention to is the spread in economic growth. There is a risk of slower economic activity next year that we're going to have to be paying very close attention to. Navigate accordingly. All right, be right back after the break. Wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
All right, so let me had a comment in chat saying all of our data is fake. I get that, right? You certainly look around and you go, you can see things that are going on. You know, again, we have this huge debate over, personal inflation rates, right? What you see at the store is not, and what you're spending, your personal inflation rate may be very different than what the government's reporting. So we say, oh, that's not valid. So that data doesn't agree with me, so I think it's fake. That's okay to think that, but why are you listening to this show at 6:45 in the morning? Because you've got money invested in the markets. So what's important? Is it your view about the economic data, or is it the market's view about the data and how it responds to that data that matters, right? Our goal is to try to grow money and try to capitalize on the opportunities. So I may not agree with the data. That's okay. It doesn't mean the data is fake. But just as a good example, the person in chat said, just take a look at all the layoffs. Okay, let's go take a look at the layoffs. Here's a chart from Liz Ann Sanders over at Schwab showing layoffs and discharges. That's the orange line. There are no layoffs, right? There's a few layoffs, right? But the jobless claims, initial claims, are very, very low. Layoffs and discharges are very, very low. We don't have any data that suggests everybody's laying off people. But look at all the store closings. Yes, we have store closings because companies are going bankrupt, like Bed Bath & Beyond. And again, you're responsible, not you personally, but you as the retail consumer, you're responsible for a lot of stores getting closed because your ass is too lazy to get off the couch and go to the store, so you order everything online. So yeah, stores are closing because they can't support retail traffic. So you're at fault for store closings. If you want to boost the economy, get off the couch. But we can go through all the data, right? Unemployment rates are very low. Well, I don't agree with the unemployment rate. That's okay. I don't agree with the inflation data. That's okay. It's okay that you don't agree with the data, but the data is the data. And what markets respond to is the official government data. They don't care about your personal view on inflation. What the markets care about, what investments care about, what money managers care about is the rate that is produced in the government data. And until that data changes, markets are going to respond accordingly. So you can fight it all you want. And again, I'm not going to disagree with you that all the data is fake. I'm not going to try to convince you differently, but having that mindset is going to lead you to make bad investment decisions. Because just because the data doesn't agree with your personal view you're not driving the market. The guys with all the money that are paying attention to that data are the ones driving the market. So until that data changes, you're kind of fighting an uphill battle. So, that's the way you got to kind of shift your focus to that. Yes, we have a lot of kids living with parents these days because of job opportunities. And I'll tell you that there's also a parental problem. My kids are no different. My kids grew up in a nice house and they didn't want for much, right? We didn't get, I grew up in a household that was, and I'm sure Brent will tell you this, he grew up the same way. The house I grew up in was about 950 square feet. It had 3 bedrooms, 1.5 baths, and a garage and a yard, right? So, and it was a nice house back then. That was a nice house back then. I grew up in a small town, about 20,000 people. Everybody worked for Dow Chemical. It was a plant town. But it's 950 square feet. We drove old cars, and we had, and as my dad said growing up, he said we always had everything we needed, but not everything we wanted. And that's a true statement. The problem with kids today, and this is our fault as parents, it's my fault. I did it to my kids. They've got a very rude awakening coming up soon. But they grew up in nice houses. They see all their friends driving nice cars. They see all these people on Instagram or I should say on the gram and on TikTok and everywhere else, kind of showing these elaborate lifestyles of traveling here and doing this and doing that. And we gave our kids experiences. I thought that was important. I was more successful than my father financially. So I was able to do things for my kids that he wasn't able to do. My dad was always proud of that before he passed away. He says, I'm proud of you that you were more successful than me. I achieved my job in life. He says, that's my job as a father, was to make sure you were more successful than me. And that's my job as a parent, to make sure my kids are more successful than I am. And that's why we push them heavily into making good choices. But a lot of the reason that kids are living with parents today, and we come up with all the excuses in the world, right? Oh, well, houses are too expensive. Rent's too expensive. This is too expensive. That's too expensive. No, expectations are too expensive. Our kids expect to live in a very nice apartment or a house that is 3,000 square feet, whatever it is, with a pool in the backyard, because that's what they think is normal. And that ain't normal, my friends. So a lot of the reason that kids are coming back home to live with parents is because I can't afford to live where I want to live. I get it. My first apartment was a freaking dump. Literally, a guy was murdered next to me in my apartment. Not like next to me in bed, but next in the next apartment over. That was like a nightly thing that was going on in the apartment complex. Gunshots were a regular occurrence. But that was all I could afford in my first apartment. That was after living in my truck, right? So I graduated from a truck to a really crappy apartment, and I was balling at that point. But I didn't have anybody to bail me out. I didn't have anybody to say, oh, yeah, come home and live. That wasn't an option. I had to make do for what I had. We have all these expectations. So again, but I understand things are expensive. Apartments are expensive. Houses are expensive. And that's a function of what we've demanded as consumers. I want to buy a house I can't afford. Mortgage companies go, okay, tell you what, I'll give you this funky mortgage over here that's split 3 ways and has a 0% down interest rate, and you can, split the other half of the mortgage to avoid PMI so I can get you in this house you can't afford. Was that really a good financial decision? But doing that has boosted the prices of homes. Why? Because you created demand for homes of people that couldn't afford them. Still today. Told you before, if you want to fix the housing problem, go back to a 20% down payment, single mortgage, PMI insurance, and guess what? House prices are going to come down because people can't afford to pay them. That's why you never had a housing problem prior to 2000, before you started doing adjustable rate mortgages. House prices grew at about 3% on average, about the rate of inflation. So a lot of the problems that we have with kids living at home is a function of choice. Choices, I should say. It's also a function of parents going, okay, sure, you can come live with me. That's not an option for my kids. You can come visit, but you have to leave. Because why? I've already explained to them that they're going to have to live in a crappy apartment. I've already explained to them they're going to have to drive a crappy car for a while. Because that's where you start. It's not where you finish. If you're finishing at that level, you've done something entirely wrong with your life. This is one of the big complaints I have about when people go, we need a livable minimum wage. No, we don't. Your minimum wage is 0. Your minimum wage is the value that you bring to the table. If you have no value, you cannot get a job. Right? The reason we have a minimum wage is to find out what kind of value you have as an employee. It's a trial. You want to come work for me? Great. I'm going to give you minimum wage, whatever it is, right? If you want to set it at $10 an hour, set it at $10 an hour. I don't care what the minimum wage is, but the minimum wage is the minimum I can pay you to do labor. I'm okay with that. That is not where you're supposed to end up. That is not your living wage. It is a trial. If you're on minimum wage for more than 3 months, you need to have a really strong self-evaluation of what you're doing in your life. Because that's just where you start. You go in, you work hard, you show up early, you stay late, you do what the boss tells you to do, you do it with excellence. You're a leader relative to your other coworkers. Guess what? You get promoted, your wages go up. You show up late, you leave early, you complain all the time, you find every excuse not to come to work. Guess what happens to your minimum wage? It either stays the same or goes away. Choices, my friends. We need to do a better job curtailing the choices of our children. All right. Now, Eric, you got me all fired up over nothing. All right. Be back tomorrow.